Hey traders, welcome to this video. Just going to cover the Nikkei 225 index. We're going to take a fundamental and technical approach, as I always do, so you get both sides of the coin and you know where to place yourself. Don't forget as well, my free training's underneath, as is my live trading room, where I do 2 or 3 hours a day for the New York session live to Academy members. So Nikkei 225, it's gone up and up and up and up and up. Perhaps if we start on our 12 monthly, you can actually see the rapid growth, okay? Post-financial crisis, okay, you have your crash, and now you're coming back to where you were a very long time ago, which is really interesting because this is the Japanese equity index, the Nikkei 225. If you look at any other index really around the world, this is very rare. You don't get a massive spike and then a drop for such a long period of time. Okay, 1990 to 2024, it's 34 years or so. Okay, it's a very, very long time. But that does sit as your reference point for where you may find traders start to liquidate entries. But why is it going up like this? Well, it's following this uptrending trajectory for a few reasons, really. The main one is subdued wage growth, okay, and increased household spending. And of course, you've got the Bank of Japan supporting that, which is pro-business, pro-growth, because there's, well, negative rates. Now, you don't see that across the world at the moment. There's not really any major economy that is sitting with negative rates. But like I said, it's the breeding ground for more and more and more growth, ultra-accommodative policies for longer periods of time, which inevitably is going to boost the country's markets more or less. So we've seen this enormous upside, this growth, this growth, this growth, this growth. So if you're going to buy it or you're a buyer, you've got to understand that you're now coming back to this previous high you saw last month, okay? So obviously the price is very high, and therefore if you're buying, you are buying late, okay? So for my, personally, my approach, I would not buy up here because you're buying into a sell zone. Okay, you know that's a sell zone because people have already, or investors and traders have already sold at this point. Okay, bearing in mind as well, you're also getting nearer and nearer and nearer to your all-time high you saw such a long period of time ago. That peaked slightly higher up at about 39,000 points. Okay, like I said, it's a long time ago, which is surprising because it's taken all this time for Japan to get back on its feet. Your key moving averages are so far down, like I said, even more reason not to buy now. And of course, you've got this extremely extended high stock oscillator, okay? So now's not the time to buy. If you're going to be an investor, personally for me, you'll need some negative market sentiment, okay, and a push down. You may find that comes at some point soon with the Bank of Japan's rhetoric about negative rates. Of course, they start to put rates up. It's going to slow growth slightly. It costs more to borrow, okay? So you may find that if you get down to something like 31,000 points in a reasonable drop, maybe 20% retracement or something like that, you would have an ideal long zone because you're sitting at your last point of yearly price action for support. And like I said, you've gone up now for 13, 14 years. Okay, so really in any economic debt cycle, it's going to take you 8 to 15 years generally until you see a larger fall. But the reason why you've had such a rush is obviously the change in the approach of the Bank of Japan, but also because you're coming off the back of such an enormous fall for such a long period of time. Okay, so if you pull your fib out for a second, okay, and you measure the kind of retracement you're looking at, you're coming nearly up to 100%, probably sitting around your 88.6, which is a kill zone really, because you've got extreme market value. Now, if you are going to be shorting, and you're going to be shorting to the upside as it rises, looking for short market value within DCA methods essentially, like we do, then you're going to want to spread it out thin. Okay, you just do not want to short here and short there because you're shorting into strength with a lack of key price action areas. If you're going to short, it's got to be spaced out. Okay, and it's got to be light. That is the only risk-averse way to spread out your entries and catch it to the short side. Now, in the nearer term, before you get to that long-term price action level, which looks quite good down here, okay, with all these levels of price action and price support, you may find a bump in the road or a stall at this early level of support. Okay, you may find that's the case ultimately when you get there. But otherwise, I should think you'll probably catch up your key moving averages, and there's a really key tech zone at this point. But even getting long there, I'd scale in lightly. So I hope that helps, guys. Trade small, trade safe. Don't forget to join my live trading room underneath, and I'll see you in the next one. See you there.